Yes, that is true. The government is giving you money to purchase a property. These are 100% loans, meaning that the purchase price of the property is being given to you by the United States government. And it's not just one way to purchase a property. There's two ways to purchase a property. So let's start with the first one. The first one is what they call an RD loan. It's a USDA, United States Department of Agriculture. Most of us have heard of that. And you relate it to agriculture. However, there's a process called rural development. And through the rural development process, you can purchase a house which is insured by the federal government. It kind of falls under the same FHA guidelines. Most people have heard of that. So you have the FHA guidelines, but this is a way to purchase a property in specific areas, and these areas are what they consider rural areas, and it's not just for first-time home buyers. These USDA Rural Development Loans are available for anybody as long as you qualify. Now, to qualify, you got to have a 620 or higher credit score. You have to show proof of income 2 years on the job. So you're working, you've been on the job for 2 years, you filed and paid your taxes, you have a 620 or higher credit score, and then it comes to what they call the debt-to-income ratio. So you can't have too much debt, but they're going to look at your income, they're going to look at your taxes, they're going to verify your job, and they're going to look and see if you have a 620 or higher credit score. And listen, there's a lot of people that just aren't aware they can purchase a property this way. So a big question that we get is, Wayne, how much home can I purchase through this program? What is the maximum purchase amount or loan amount? And it's not a loan amount, it's an income limit. So what they do is they limit you. So if you make too much money, you can't go through this process. But you'd be surprised, because the income limits in just about every county across the United States is over $100,000. But it's going to vary. We'll put a link below so you can easily click and see your county, and it will show you. You can also click on a map link. We'll put that link below so you can actually put in the property address of a home that you may have interest in, and from there you can see if that property is actually eligible on the map for these types of RD loans. Now, I think it's really important for people not to get discouraged in thinking, oh, well, these are way out in the boondocks, or these are way out in the woods, or these are way out in the country. I don't want to live way out in the country. I assure you, they are not. These are suburban areas. For example, the area that I live in, just north of Lake Pontchartrain, 30 minutes from New Orleans, the entire St. Tammany Parish falls within this USDA eligibility. So, and let me assure you, there are 2 Starbucks within walking distance of my office, a Fresh Market, and a Whole Foods, and a Walmart grocery store. Like, it's stuff everywhere. So you really need to take heed on where's the property located. Let's take a look at the map. Let's also look at those income requirements, because most of the time, if you're making under $103,000, you can qualify for these loans. But it gets a little bit better. So if you're a household, for example, of 1 to 4 people, let's say you're a husband and a spouse, and you're making $100,000 a year and you have 2 children, well, then you fall within that income limitation. And if you do, you can purchase a property. Now, let's say you have a household of 5 or more. From there, the income limit is around $136,000. Keep in mind, that's a basis, because it's going to vary county per county. For example, in San Francisco, San Diego, out in California, those counties are income of $248,000. So let's say you want to purchase a property on the outskirts of Oakland, California, then those properties, an income requirement is maxed at $248,000. Now, to apply for these types of loans is no cost and no obligation. You can get with the local lender. We can refer you to a lender. We can also refer you to a real estate agent in your area, state, city, county, to do these types of loans, because you want to make sure that you're dealing with and working with someone that's familiar with the process, understands the process, because most importantly, the seller is going to pay your closing cost on these types of loans. That means that the agent and the lender that you're working with are educated to the process, they understand the process, and they're informed that you're doing an RD loan, rural development, of which the seller needs to pay your closing costs. Now, closing costs typically run about 3 to 3.5%. Totally depends on which county, parish you live in, but it's 3 to 3.5% will cover your closing cost on these types of loans. And the seller can pay your closing cost. And I can assure you, the market has shifted. It's changed quite a bit. And they're to the point now, most homeowners selling their property will gladly pay your closing cost and prepaids, as they call it, for you to purchase their property. Now, as I mentioned, these loans are not for first-time home buyers. They're for any person that qualifies. So you can have owned a home and purchased a home like this and sell that home, put the equity of that money in the bank and go do it again. There's no limit. If you have $30,000 in the bank and you want to do this type of loan, they don't look at it on a basis of how much money do you have in the bank. They look at it as your income. So they're looking at income, credit, job history, and debt to income ratio. In other words, how much money you have coming in every month and how much money you have going out. So how they factor that is this. They typically will loan you 31% of what your gross income. That's before you pay taxes. So let's say you make $10,000. A lot of you may make more, some of you may make less. For simplicity, let's use $10,000. If you make $10,000 a month, that's your gross income. That's what your employer pays you before you pay taxes. From there, let's say you have $2,000 a month in expenses, car notes, student loans, credit card payment, whatever it may be. At that point, you have $8,000 is your adjusted gross income. And they will loan you 31% of the $8,000 to apply toward a mortgage payment. Now, what they also factor in is how much of that $10,000 was debt. And that's when you reach what they call the back-end ceiling of 42%. And listen, I know all this information can sound like it's just rocket science, but you have to know having a good lender and having a good local agent work with you through the process makes it so much easier and so much less stressful. And most importantly, watching videos like this. By the way, give us a thumbs up and subscribe to our channel because we're going to be coming at you with more and more videos just like this one. Now, another question that we get is, Wayne, is there a class required? Do we have to take an online study course or a class or a test? No, none whatsoever. It's that simple. You just talk with the lender and get with the real estate agent and they will show you the properties that qualify for these. You can also go to the links that we're going to put below to type in a property address. So say you're searching and looking for a property, you like that property, you can then go to the link that we're going to put below and it will tell you if that property is eligible for the USDA loan. So look, you can go FHA. You don't have to do an RD loan, but keep in mind if you do an FHA loan and purchase a $300,000 property, it's going to take you a minimum of around $9,000 to purchase that property. You can purchase a $300,000 property with the RD USDA loan and it costs you no money to purchase that property. Now, a lot of people may say, but Wayne, you're purchasing a property, it's 100%. How is that healthy? Well, keep in mind, it's not 2008. You have to qualify for these loans. You can't just fog a mirror. They're not doing what they call ninja loans like they did years ago with no income, no job, no assets, none of that. You have to qualify. You have to know that you're on the job, taxes, everything to qualify. And most importantly, these are fixed rate loans. The mortgage payment itself that you pay to your mortgage company will not go up. It is fixed for 30 years. Now, some people say, well, Wayne, your payment will go up. Your payment may go up a little bit if your taxes and insurance go up, but your fixed payment to the mortgage company, where you're paying your principal balance and interest on the money that you borrow, does not change for 15 or 30 years, whichever term limit you put on the property. Now, there's a couple of more things that make this type of loan beneficial, and that is closing costs. The closing costs are actually lower. So when you go to purchase this property and the seller pays your closing cost, they don't have to pay as much in closing cost because it's lower closing cost on a USDA RD loan. The other thing that's beneficial is you get a lower rate. So you get a lower rate as far as a fixed interest rate. And the reason for that is these loans are basically insured by the federal government. Now, do you have to put a deposit down on the property, or do you have to put a deposit down on this type of loan? The answer is yes. You don't necessarily have to, but we don't see it too often that people don't put at least $500 to $1,000 deposit down, and they call it the earnest money deposit. It's your money in good faith stating that you're going to purchase the property. But keep in mind, you're not purchasing the property in as is, where is. There's always your due diligence period of which you can inspect the property, and after you inspect the property, you can then tell the seller, hey, I still want to buy your house, but there's 3 broken windows, a couple of missing shingles, and the toilet's a little loose. Would you mind fixing those items? And then we'll still proceed with the purchase of the property. And 99.9% of the time, homeowners gladly do that for you to purchase their property. Now, keep in mind, once you close on that property, it is an as-is sale, meaning that you can go back on the seller. Everything has been signed, done as is, and it's really hard to go back on the seller once you physically close on the property, which leads me to perhaps purchase a warranty on the property, or a good agent will work with you to get the seller to pay for the home warranty for you. And listen, those things run about $660. They cover the house for 1 year. The seller can pay it for you. It covers your appliances, central heat and air, all of that stuff. So if you don't have a whole lot of money and you're purchasing a property and it's taking you very, very little to get in this property, you don't have to have a whole lot of money in the bank. The last thing you want to do is close on a property and then the central heat and air go out, or the electric stove go out, or the gas stove, or the refrigerator, whatever it may be. Having a warranty on the property will save you literally thousands of dollars. And most importantly, the seller's going to pay for it for you. Another important question is, can you buy a fixer-upper or foreclosure? You can purchase a fixer-upper or foreclosure through this USDA RD loan. However, it has to meet the FHA guidelines, meaning that that property has to have a stove in it. It has to have a means of which the property is heated and cooled. So it has to fall within those FHA guidelines. If you're looking at a property that's really in a dilapidated state or dilapidated condition, it's very likely that you can't get this type of loan. Now, if you watch my videos long enough, you've heard me talk about buy your first property or buy your second property. Buy a property and let it be a duplex, a triplex, a quadruplex. Live in one side for a year, rent the others out, then you can sell that property, or most importantly, hang on to that property. Now, the unit that you were living in, you can turn around and rent that unit out after you live in the property for 1 year. So the question is, can I purchase investment property through this? Yes, you can, as long as you live in at least one of the units. If it's a duplex, you got to live in one side. If it's a triplex, you got to live in one of the units. If it's a quadruplex, meaning 4, you got to live in at least one of the units for 1 year. For 1 year, as long as you live in it for 1 year, after which you can move out, put a tenant in the unit that you were living in, you can sell that property, or you can hold it as a rental. So think about it. You just purchased a property, a duplex, triplex, quadruplex. It cost you no money out of pocket. You lived in one side for a year, after which you can sell the property, or you can rent the property out. And you bought that property for no money out of pocket. Now, if you sell this property, you're going to have equity. You're going to have what they call earned money on that property. When you sell that property, the money that you earn on that property, you don't have to pay it back. It's your money. You've earned that money. And also, if you use it as your personal residence, there's no tax gain. So keep in mind, you just bought a house, and it could be a single family home, a duplex, a triplex, a quadruplex for no money out of pocket. You've lived in it for a year, 3 years, 5 years. You can turn around and sell that property if you want. Take the equity, the profit that you make off the sale of that property, put it into another property. You don't have to pay any taxes on that money because it was your personal residence, nor do you have to pay any kind of recapture money to the federal government. It's a win-win. Now, once you're qualified, you got with an agent, you found a property that you like, you wrote the contract, did the inspection, they had it appraised, you close on the property. All of this typically takes 30 to 40 days. It used to take much longer. Now it's much, much faster. So from the time you write the contract on that property to the time limit that you're getting the keys is 30 to 40 days. Now, after you close on the property and you get your keys to the property, your mortgage payment is typically not due for 30 days after you close on the property. But keep in mind, if you close on a property, for example, on March 15th, it cost you no money to purchase this property, your first mortgage payment is not going to be until May 1st, 45 days after you've closed on your home. So if you've liked this video, give us a thumbs up, subscribe to our channel, and if you're looking to purchase a property and you need a lender in your area or a real estate agent in your area, you can simply go to contactwayne.com. We'll put it right here on the screen. We'll put a link below. Give us your information. We'll connect you with a lender and a real estate agent in your hometown.